The foundation of enduring success in the market, according to Richard Wyckoff, is not the pursuit of large gains, but the rigorous and absolute preservation of capital. This philosophy mandates that trading is not a speculative pastime or a series of gambles driven by emotion or rumor. Instead, the market campaign must be approached with the same calculated gravity and operational structure as any major commercial enterprise. Capital preservation must stand as the primary, non-negotiable objective that governs every single decision made by the operator. To codify this professional approach, Wyckoff insisted on the requirement for a written trading plan. This document must strictly define the methodology for market analysis, the criteria for entry and exit, and most importantly, the rules for risk management. Without this structural blueprint, the trader is left to the mercy of their own fluctuating psychology, which invariably leads to ruinous decisions. The plan serves as the objective, rational partner that overrides the impulse to trade based on hope or fear. The stop-loss order in Wyckoff's system is not a suggestion or a discretionary tool to be utilized when convenient. He considered its use an absolute, non-negotiable law for survival, a mandatory component of every single transaction. The failure to employ a stop-loss is considered an act of financial negligence, inviting the complete destruction of one's trading capital. This fundamental law is the core mechanism that enforces the primary objective of capital preservation. The true function of the stop-loss is not merely to limit a dollar loss, but rather to signal that the original trade premise has been conclusively proven incorrect by the market's action. It is the acknowledgement that the structural justification for the trade no longer holds true. The stop-loss is the trader's admission of error, executed automatically and without the hesitation of human judgment. By accepting this small, predetermined loss, the trader maintains the capital and the psychological composure needed to engage the next more promising opportunity. Wyckoff vehemently warned against the sin of guesswork in determining where to place a protective stop-loss order. This fatal flaw includes the common practice of using an arbitrary percentage, such as a 2% rule, or a fixed point stop-loss, like placing it 5 cents away from the entry price. Such arbitrary measures fail because they have no basis in the actual supply and demand dynamics of the stock being traded. The market operates without any knowledge of a trader's account size or their personal risk tolerance. The market price action driven by the maneuvering of large professional interests is the only valid guide for risk placement. A stop-loss that is not structurally sound is easily breached by normal market fluctuations, leading to unnecessary and frustrating losses. The arbitrary stop-loss is a self-inflicted wound that forces the trader out of a potentially profitable position prematurely. Wyckoff's methodology demands that the stop must be determined exclusively by the chart's landscape of supply and demand, reflecting true market logic. The core principle of Wyckoff's risk control is the logical danger point method. This principle dictates that the stop-loss must be placed at the specific price level that fundamentally invalidates the structural reason for entering the trade. It is the point at which the market's action contradicts the bullish or bearish hypothesis upon which the position was established. This placement ensures that the trader is only stopped out when the premise is definitively broken, not by random noise. The logical danger point is the price that, if reached, signals that the dominant force, whether accumulation or distribution, has failed to materialize as anticipated. By using this method, the stop-loss becomes an analytical tool, not just a protective one. It forces the trader to ground their risk management in the verifiable evidence of the chart pattern itself. This is the intellectual rigor that separates the professional operator from the amateur gambler. For long positions entered during the phase of accumulation, a specific structural stop-loss method is employed. If the entry is taken after a spring, which is a decisive test of the low that quickly reverses, the initial stop-loss is placed just below the low of that spring action. Alternatively, in a wider context, the stop may be placed just below the lowest point of the selling climax, which marked the initial capitulation. Violation of this low confirms that the selling pressure has resumed and the accumulation premise is broken. If the long entry is taken at a last point of support within an established uptrend or after a consolidation, the stop loss is positioned just below the low of the most recent reaction. This reaction low represents the structural line in the sand where professional support entered the market. A violation of this level breaks the established bullish pattern of higher lows and signals a change in the character of the market action. This structural breach is the logical danger point that necessitates immediate exit. For short positions entered during the distribution phase, the structural stop-loss placement is the mirror image of the long rules. If the entry follows an upthrust, which is a rally into resistance that fails to hold new highs, the initial stop-loss is placed just above the high of that upthrust. Similarly, if the entry is after an upthrust after distribution, the stop is placed above that specific rally high. Breach of this high indicates a reassertion of demand and invalidates the distribution hypothesis. If the short entry is taken at a last point of supply, which is the final rally into resistance before the downtrend begins, the stop-loss is placed just above the high of that rally. This high represents the structural point where professional supply overwhelmed demand. A move above this last point of supply indicates that the market is stronger than anticipated and the bearish pattern is broken, demanding the closure of the short position. These precise placements ensure that risk is defined by the intentions of the large operators, not by arbitrary calculation. The Drawdown Survival Formula begins with the mandatory integration of risk and reward, codified by the 3-to-1 rule. This rule stipulates that the anticipated profit from a trade must be at least 3 times the initial defined risk before a trade is even considered viable for entry. This is a foundational mathematical requirement, not a goal to be hoped for, and it must be calculated before any capital is committed. The 3-to-1 ratio provides the essential mathematical buffer for long-term survival in the unpredictable market environment. The survival logic behind this ratio ensures that a trader can withstand the inevitable losing streaks or drawdowns and still remain handsomely profitable over a series of trades. A trader operating with a 3-to-1 minimum reward-to-risk ratio can be wrong on a significant number of trades, such as losing 50% of their transactions, and still generate substantial net gains. This mathematical foundation is the ultimate defense against the psychological damage and capital erosion caused by inevitable strings of losses. It is the core of professional expectancy. To objectively determine if the 3-to-1 ratio is achievable, Wyckoff's method mandates the use of point and figure chart projections. These charts are utilized to measure the horizontal action, the cause, within the accumulation or distribution trading range. This measurement is then projected vertically to determine a probable price objective, the effect, that the subsequent trend should reach. The projected price objective must then be compared against the initial risk defined by the logical danger point stop-loss. If the resulting projection does not confirm that the potential profit justifies at least 3 times the risk, the trade must be instantly discarded. This disciplined objective method prevents the trader from entering low probability or high-risk trades simply out of impatience or a desire for action. The cause and effect principle provides the quantifiable evidence that validates the trade's mathematical foundation, which is the true prerequisite for entry. It is the ultimate filter for trade selection. The second critical component of the survival formula is position sizing, which must be calculated in perfect harmony with the logical danger point stop-loss. The size of the position is never determined arbitrarily, but is instead calculated based on the precise distance in dollars from the entry price to the location of the predetermined structural stop-loss. This calculation is the mechanism that ensures consistent and controlled risk across all market environments. The cardinal rule of capital allocation dictates that the trader must risk no more than a small fixed percentage of their total trading capital on any single trade. This percentage is typically 1 or 2%, and it must be strictly adhered to regardless of the trade's perceived quality. This small, fixed risk ensures that no single loss, even a catastrophic one, can materially damage the overall trading account. This is the true definition of managing portfolio risk. The core principle uniting the stop-loss and position sizing is the concept of consistent account risk. A trade that requires a wide stop loss due to a large trading range or significant volatility will necessitate a smaller position size to maintain the fixed 1 or 2% risk of the total capital. Conversely, a trade with a tight, clearly defined structural stop loss allows the trader to take a larger position size. This principle ensures that the dollar amount risked remains constant across all trades, regardless of the stock's price or volatility. By adjusting the share quantity based on the distance to the logical stop, the trader effectively standardizes risk across the entire portfolio. This removes the emotional element from position sizing, as the math dictates the exact number of shares or contracts to purchase. The consistency of this approach is vital for achieving the stable, long-term equity curve that characterizes professional trading. This systematic calculation is the bedrock of disciplined capital management. Wyckoff identified several cardinal sins that deepen drawdowns and lead to the eventual ruin of traders. The first of these is the temptation to overtrade, which involves taking positions that exceed the calculated position size or trading with excessive frequency. Overtrading is often a symptom of emotional instability, born from impatience or the desire to quickly recover a previous loss. Controlling position size and frequency is therefore essential to withstand the inevitable strings of losses that all traders face. The second, and perhaps most forbidden act, is the practice of averaging down. This involves purchasing more shares of a security as its price drops, thereby lowering the average cost but dramatically increasing the total capital at risk. Averaging down is an act of sheer desperation as it compounds a mistake and exponentially increases the potential for catastrophic loss. Wyckoff considered this action a cardinal sin in trading, a direct violation of the capital preservation mandate. Averaging down demonstrates a refusal to accept that the original trade premise has been proven incorrect by the market's action. Instead of cutting the loss at the logical danger point, the trader throws good money after bad, betting that the market will reverse simply because they need it to. This action turns a controlled, small loss into a potentially account-destroying event. The professional trader recognizes the error and exits, preserving the capital for the next opportunity. The final element of Wyckoff's risk control system is managing the winning trade, focusing on protecting paper profits during normal trend corrections. The purpose of the trailing stop mechanism is twofold: to protect the accumulated profits and to allow winning trades to run for substantial gains, capitalizing on the full extent of the market's movement. This mechanism ensures the trade survives the inevitable normal market reactions that occur within a healthy trend. In a confirmed uptrend, the stock will make a new high, followed by a normal healthy reaction on diminished volume, which is a sign of profit-taking and minor selling. After this reaction is complete and the price begins to advance again, the original stop-loss order is moved up. The new trailing stop-loss is placed at a point just below the extreme low of that most recent healthy reaction. This placement uses the market's own structure to define the continuation of the trend. This process is repeated as the trend continues, with the stop continually moving up to protect the profits accrued from each subsequent advance. The trailing stop is always placed at a structural point, a reaction low in an uptrend or a rally high in a downtrend that, if violated, signals a change in the character of the move. This ensures the trader is not shaken out by minor volatility, but is protected from a genuine structural trend reversal. The stop-loss evolves from a risk control tool into a profit protection mechanism. The entire philosophy of managing the stop-loss is summarized by the one-direction rule. A stop-loss order can be moved in one direction and one direction only, in the direction of the trade to reduce the initial risk and protect the accumulated profits. Once a trade is profitable, the stop-loss should never be moved back to the original entry point or, worse, moved further away from the current price. It is a one-way street toward profit protection. Moving the stop-loss further away to accommodate a loss is a catastrophic act of emotional trading, akin to tearing up your fire insurance just as the fire starts. This decision is driven by the refusal to accept a loss and the emotional desire to avoid the finality of a losing trade. Such an action immediately violates the fixed risk percentage rule and can lead to unlimited, uncontrolled losses. The professional operator accepts the outcome dictated by the market and adheres to the one-direction rule without exception. Wyckoff's risk control system is a unified, interlocking defense mechanism designed for longevity, not a collection of isolated rules. The system begins with market structure, where the logical stop placement dictates the precise, quantifiable distance of the risk. This distance then directly informs the position sizing calculation, which ensures that no more than 1 or 2% of the total capital is ever at risk. This structured approach removes the variability of human emotion. Furthermore, the mandatory 3-to-1 minimum reward to risk ratio ensures that even if the trader is right only half the time, the strategy remains handsomely profitable over the long term. This mathematical foundation is the ultimate guarantor of survival through inevitable drawdowns. The entire framework is then guarded by the non-negotiable stop loss, which acts as the final, absolute law of capital preservation. The discipline to adhere to these interwoven rules is what provides the emotional detachment necessary for professional judgment in the heat of market action. The trader who follows this system is not reacting to price fluctuations with fear or greed, but is executing a pre-planned, rational strategy. This emotional detachment is the final, crucial component of Wyckoff's recipe for longevity. It ensures the trader preserves their ability to trade tomorrow, regardless of the outcome of today's market movements, which is the ultimate definition of professional success. The principles of longevity and capital preservation Wyckoff established are foundational, but their true power is unlocked when they are applied within a comprehensive market framework. To truly master this systematic approach, from recognizing accumulation to executing the precise risk control measures we have discussed, a trader must immerse themselves in the original thinking. That is why we recommend the adapted edition of his classic work, How I Trade and Invest in Stocks and Bonds, which clearly lays out his proven methods for analyzing market action, identifying the intentions of large operators, and making sound, informed trading decisions. This book is the essential companion to this video, providing the depth needed to transition from theory to consistent practice, and you can find the link to secure your copy in the description below. Mastering Wyckoff's risk control is the journey from speculative gambling to professional operation. It is the commitment to a structured, analytical, and disciplined approach that guarantees survival. This is the ultimate lesson from one of the greatest market minds in history.